Hi, my name is Ashok. I'm from FInEx Training Institute. We are providing free classroom training in Mumbai for one entire month for CFA aspirants so that they themselves can decide if they wish to continue this certification. Please feel free to contact us for further details. Thank you.
Free cash flow to the firm and free cash flow to equity. The difference between these two terms are, like, if I say free cash flow to the firm, I'm going to assume like as if I don't have to pay any interest. If I don't have to pay any interest, how much cash will be there within the firm? So that is free cash flow to the firm. Free cash flow to equity means I'm just considering all the facts of paying interest. So after paying all interest, how much free cash flow is there within the firm, which I call that as free cash flow to equities. Okay, so this is after paying interest. Okay, this is after paying interest. After paying interest, and here assuming no interest. Assuming no interest. Okay, the similarity is in both the cases I'm taking only cash transactions, be it FCFF or be it FCFE. I'm taking only the cash transactions. Okay, so first let's calculate free cash flow to the firm. Now in order to calculate this free cash flow to the firm, there are multiple formulas to calculate this. So I'll be explaining that, however, with an example. So let me write the example here, the income statement format first of all. So I'm writing an income statement format as the example here. Let's say sales 10,000, then minus cost of goods sold 6,000, gross profit 4,000, minus sales general and administration expenses, let's say 2,000. So this 2,000 is your EBITDA, then minus depreciation, let's say 1000. I'm taking a high depreciation so that I get 1000 here as EBIT. So I'm taking 1000 as EBIT. Then minus interest. So let's say I'm paying interest of 100. Then earning before tax, it will be 900. Then I'm paying tax of 30 percentage. So 900 into 30 percentage comes to 270. So I'm supposed to pay 270 as the tax. So finally 630 will be my uh, earning after tax, or net income, or net profit, or profit after tax. Okay, this is 630. Fine. So now this is the given example. On this basis, how do I calculate free cash flow to the firm? So let me begin with net income. So this is an indirect method where I'm going to start from net income, and then I will check all the transactions. Okay, I will check all the transactions from in the descending order. So from here I will keep checking all the transactions. I will keep going up, and I'll keep checking all the transactions. Remember, what I want is I want I want only cash transactions, and I want only uh, cash transactions, and I don't want interest. So no interest. Okay, I'm assuming as if like I don't have to pay any interest. So based on this only I'm going to calculate free cash flow to the firm. So number one, net income. So from net income I'm going to calculate this. So my net income is 630. So I'm writing 630 here. Then I go up, and what I see is I am paying tax. So tax is fine for me. Then earning before tax, it is just the balancing figure, so that is fine. Then interest is not fine because I'm assuming as if like I don't have to pay any interest. So interest is 100. Okay, so interest paid is 100. So if interest paid is 100, so that means if I don't pay any interest, what will happen? I will get back that interest. Okay, so that means I will get back this 100. However, when I will get back this 100, my income will go up by 100. When my income goes up by 100, I'm supposed to pay more tax. So I'm supposed to pay 30 percentage tax. So I will be left out with only 70 percentage then. So I will not get 100, I will be having only 70. How? Because this much I will get, but I have to pay tax. 1 minus tax rate. So 100 into so it will go like this, plus tax into 1 minus, I mean plus interest into 1 minus tax rate. One minus tax rate. So which will be 100 I am getting, but I have to pay tax, which is 30 percentage, let's say. So 30 percentage if I pay tax, then I will be having only 70 percentage of 100. So 70 percentage of 100 comes to 70. So net I will have 70 in my hand when I don't pay the tax of 100. I will have 70. So that's why I'm adding 70. Further, it goes up. Let's say further here, EBIT. EBIT is just the balancing figure. So again I go up. Depreciation. So depreciation is 1000. So depreciation is 1000. So again depreciation also is something a problem for me because I want only cash transactions. So I'm supposed to rectify that one. So already depreciation of 1000 has been deducted here. So what I will do is I will add back that depreciation. So depreciation 1000 I am adding back. Okay. Then EBITDA is the balancing figure. Sales general administration is an acceptable transaction for me. Gross profit is a balancing figure. Cost of goods sold is an acceptable transaction. Sales is an acceptable transactions. So these are all the free cash flow to the firm. Okay, but still I need to make some more changes as well. See, so far how you can understand is, you think like you are negotiating salary, you are sitting in an interview and you are negotiating salary. So assume that your salary is something like 1 lakh. This is the gross salary. So this net income, you think like gross salary of 1 lakh. Now this 1 lakh, when your employer says your salary is 1 lakh, your next question will be, what is my take home salary? Because why do you want to know your take home salary? Because even though they are saying 1 lakh, finally there might be some perquisites and other perquisites and other incentives that might be included, which may not come into your hand, right? So let's say some transport expenses 10,000, and then some some Sodaxo coupons 10,000. All those they are adding, which you are not going to use anyways. So finally you are going to get only 80,000 in your hand. Now can you call this 80,000 as your take home? This is the take home salary, but as your free cash flow, not. This is your take home salary. This is your take home salary, but you cannot call this 80,000 as your free cash, because from 80,000, let's say you have to pay for let's say you have to pay you have some other fixed expenses. Let's say you have to pay 30,000 for your rent. So when you have to pay 30,000 for your rent, you are left out with 50,000. So now 50,000 is something which is going to be completely free in your salary. 50,000 is completely going to be free. Similar calculation we are doing over here. 630 is the net income, plus interest has been added 70, plus depreciation 1000. Now this is not enough. What we have to do is we have to plan for some other fixed expenses, like over here rent you have deducted 30,000, then 50,000 is free. Similarly, other expenses which is going to happen for the company. So they are going to deduct that as well in advance. Say for example, every year they incur working capital investments of, let's say, 100. So they are supposed to deduct that as well. Okay, so they are deducting that in advance, and also some fixed capital investments as well. So this bracket indicates minus. Okay, so fixed capital investments as well, so 500. So these are all the fixed expenses similar to your rent. Okay, then whatever is left out, that I can call that as free cash flow to the firm. Okay, so this is my free cash flow to the firm. 600 plus 70 plus 1000 minus 100 minus 500. So let me calculate this. 630 630 plus 70 plus 1000 minus 100 minus 500 comes to 1100. So this 1100 is free cash flow to the firm. Okay, now there are other ways also to do this. So example, imagine now in this case itself, so imagine in this case itself, now instead of so you want to calculate free cash flow to the firm, but instead of net income they have given you EBIT in the question. So from EBIT itself you are paying tax. So from EBIT, when you are paying tax, 1 minus tax rate, so which will be EBIT is 1000 over here, and from here itself I am going to pay tax of 30 percentage, let's say. So that means I'm not doing these mistakes of interest. I'm not paying any interest, I'm directly paying tax, so which is good. So that's what free cash flow to the firm wants. So EBIT is how much? EBIT is 1000, and from this 1000 I'm paying tax of 30 percentage. So 1000 into 1 minus 30 percentage comes to so 700. So 700 I'm paying. I mean 700 is EBIT into 1 minus tax. Okay, 700 EBIT into 1 minus tax. Okay. So after this, I'm just checking now. So interest anyways I'm not paying, so that is not the mistake. So there is no need to rectify it. So I'm not going to add back that interest. So down everything seems to be fine for me, because this was the only problematic transactions, that is interest, which anyways that mistake has not happened over here. Now when I go up, I see depreciation. Now depreciation is a problem for me because it is a non-cash transaction. So because they have deducted depreciation, I will add back that depreciation. So plus depreciation. So depreciation of 1000. Okay. Yeah, and then rest all other transactions seems fine for me. All these transactions are okay. Fine. So all these are fine. So all I have to do is further I have to reduce minus working capital investments, which I took as 100 in this case, and minus fixed capital investments, which I took as 500. So you calculate this also. 700 plus 1000 minus 100 minus 500, you will get 1100, which will match with this number. So you do it either EBIT method or net income method, you are going to get the same answer. Okay. Now there are couple of other ways also. Let's say instead of EBIT you have been given as EBITDA. So EBITDA, so from EBITDA you are paying tax. So from EBITDA you are doing 1 minus tax rate. So from EBITDA, so your EBITDA is 2000. So from here you are directly paying tax. Okay, so when you are directly paying tax, that means you are not making the mistakes of interest, depreciation, and also you are not making the mistakes of interest. Okay, so both these mistakes has been avoided. So directly I'm paying tax. So EBITDA is 2000. So 2000 into 1 minus 30 percentage. So that comes to 1400. So 1400 is EBITDA. Then now what next? Because there doesn't seem to be any mistakes here. Interest is not unnecessarily deducted. So here all seems to be fine. Okay, but however, still, there is a mistake over here. The mistake is, see, when I'm not deducting interest, so I'm not deducting, sorry, when I'm not deducting any depreciation, and when I'm directly, paying interest. Okay, when I'm directly paying interest, I am kind of, overpaying interest. How I'm overpaying interest is, see, now 2000 is the, you know, let me take another example and explain it to you. So let's say EBITDA is something like I'll take different number as let's say 1000 here. Depreciation is let's say 100, so it becomes 900. Just I'm taking another quick example, 900. So this becomes EBIT 900 minus interest. So interest is not our worry here, so I'm taking interest as 0. So earning before tax will be 900, then tax will be 30 percentage. So 30 percentage will be 30 percentage will be 270. So 270, and that comes to 630 here. Okay, 630 as my net income. Now another case, if I'm directly, so let's say I'm assuming there is no depreciation, so my EBIT will be 1000. There is no interest as well, so here also it will be 1000. Now if I pay 30 percentage, so it comes to 300. So that means what happens is, if I include depreciation, I'm supposed to pay only the 270. But if I don't include depreciation, I end up paying more tax. Okay, how much more tax? 30. Now what is that 30? That 30 is nothing but, this 30 is nothing but, this 30 is 100 into 30 percentage tax. So I'm kind of paying over tax 30 percentage. Okay, 30 percentage of 100 comes to 30. So I'm, when I'm directly paying tax from EBITDA, if I'm directly paying tax from EBITDA, so I'm paying 300, whereas after reducing depreciation, I'm supposed to pay only 270. So I have overpaid. How much did I overpay? 30. How did I get this 30? That is depreciation into tax rate. So I have overpaid. So because I have overpaid, I'm supposed to add back that depreciation into tax rate. So what is the depreciation that I have taken in our example? 1000. Okay, so 1000 into 30 percentage, so that comes to 300. So 300 I'm supposed to add. Okay, so rest all transactions seems to be fine, rest all are fine. So rest all are fine. So as usual, I will do additional working capital investments of 100, then minus fixed capital investments of 500. So let's total this one now. 1400 plus 300 minus 100 minus 500 comes to 1100. This is free cash flow to the firm. Okay, free cash flow to the firm. Yeah. Now there is another way also to calculate free cash flow to the firm. Shortly, I just tell you only the format. If I know free cash flow, if I know cash flow from operations, then how I can do is I can add back, because in cash flow from operations, interest is already reduced. So I will add back that interest into 1 minus tax rate, and then minus fixed capital investments. This also will give me free cash flow to the firm. Okay, so yeah, okay, so these are all the different ways to calculate free cash flow to the firm. Now if I summarize all this, so if I summarize free cash flow to the firm formula, so it will be like net income, then plus depreciation. I can call this depreciation as non-cash charges as well. Okay, non-cash charges or depreciation, then plus interest into 1 minus tax rate, minus working capital investments, minus fixed capital investments. Okay, another way is if I start the story from EBIT into 1 minus tax rate, then plus depreciation, minus working capital investments, then minus fixed capital investments. All these will give me the same free cash flow to the firm. Then another way is EBITDA into 1 minus tax rate. If I deduct like this, then I will have to add back depreciation into tax rate, then minus working capital investments, minus fixed capital investments. This will also give me the same free cash flow to the firm. Or the other one is cash flow from operations plus interest into 1 minus tax rate, then minus fixed capital investments. So all these will give me the same value, free cash flow to the firm. So these are all the different ways to calculate free cash flow to the firm. Okay, now to calculate free cash flow to equity, I am not getting into the numbers now, it will become too big a video. So I'll just jot down the formula, it should be good enough. So one is if I have free cash flow to the firm, from there I have to just reduce, because free cash flow to the firm I have added interest. While calculating free cash flow to the firm, I will reduce the interest. So interest into 1 minus tax rate. Okay, and then plus or minus net borrowing, because if company is borrowing or repaying, uh, that will be taken into consideration. So company is, if the company is borrowing more, it will be plus net borrowing because there is more cash inflows. If the company is repaying the debt, then there is cash outflow, then it will be minus net borrowing. Okay, then another way is cash flow from operations minus fixed capital investments, and then again plus or minus net borrowing. So if I do like this, I will get free cash flow to equities. Thank you so much for your time.